The IPO we've been waiting for, or not really? LinkedIn. I'm Dan Roth, Fortune in New York.
I'm Dan Primack, Fortune's term sheet in Boston.
Let's deal. All right, Dan, let's talk about this LinkedIn IPO. Give us the basics.
LinkedIn is planning to price its IPO on Wednesday night, which means it'll begin trading in New York on Thursday. The big story here is the company originally filed back in January to raise about $175 million, and just 2 weeks ago said it would price its shares at between $32 and $35 a share, offering about $7 million plus. On Tuesday morning, it raised that price by over 30%, saying it's going to price between $42 and $45 a share, which could give it a valuation north of $4 billion.
But I think the real story here is how other startups are looking at this, and also what people who run the secondary markets are thinking.
Yeah, to me, LinkedIn is the big validation or non-validation for these secondary markets, where people have been trading shares of internet companies, private internet companies, often without knowing much about what these companies do or how much these companies make. Of the so-called Big Five, which get referred to as LinkedIn, Facebook, Twitter, Zynga, and Groupon, LinkedIn is going to be the first one to go public. So if it actually prices higher than where it was trading on these private markets, that's a big validation for those markets because they're supposed to trade at a minor discount. If somehow it prices lower or, say, does what a RenRen did, which is price high and then get real sluggish in the aftermarket and trade down, then it could cause some real concerns in those private markets.
Right, so basically this is our indicator of whether we've got a bubble or not. And if LinkedIn does really well, in fact, it could actually help spur a bubble. It could create a bubble by a lot of other tech companies, these startups who are trading on the secondary markets thinking we have to go public in the wake of LinkedIn's success. Is that right?
Yeah, again, if I'm a private company and I'm trading at, $20 billion or more, if I'm Facebook trading at $80 billion, and I see LinkedIn successfully price higher than where it was on the private markets, that says to me, hey, my private market valuation, that's legitimate. I can get that in New York, so I'm going to go. And also, there might be a little bit of a rush to the exit here. There's been talk that Groupon is about to file any day now. Facebook, there's been talk that they might actually try to price before next May when they're kind of quasi have to. So yeah, I think there's going to be a rush if LinkedIn proves successful. It means public market investors want these highly, highly priced internet companies.
Dan, who is going to do well if LinkedIn does well in its IPO? Who stands to gain from this?
Any of the companies that are currently trading on the private markets right now, particularly those other big four, because it's going to be an indication that there is public market interest in this sort of company, and more specifically in this sort of company at a price and a price range which far exceeds normal tech company ratios.
And do we know who the insiders are who are going to be getting wealthy off of this?
Oh, specifically off of this? I mean, the big one obviously is Reid Hoffman, who is the company founder. He's now a partner at venture capital firm Greylock, which also happens to be an investor. You have other venture capital firms that include Bessemer Bain Capital Ventures, who has a partner who is the brother of the former LinkedIn CEO. Those are the big insiders, but you'd also have dozens and dozens, if not hundreds, of retail investors who have bought shares on the secondary markets over the last couple of years.
That's right. And this isn't just to be clear, this isn't a company that's come out of nowhere. This isn't a Twitter that is just it's only a couple years old. LinkedIn's actually been around for a while and has gone through some growth. Growth sort of flattened out. It picked up again. It's not a Groupon, basically.
No, it's not. It's a company that's been around for a while. It's one of the older social networks, if you want to call it a social network. And if you look at its financials, it was profitable in fiscal 2010. Now it's warning people it won't be profitable in fiscal 2011 because it plans to make what it's calling investments in expansion. But it's got decent, its revenues grow year over year. It's hiring business, which is kind of the job ads and recruiters paying to get in, et cetera. That's the biggest part of its revenue. And yeah, it's a legitimate company with legitimate revenue and, as of today, profits.
Now, I think what you're going to see once this happens is that there's going to be a lot more young companies that move from the AA, basically just being handed off between venture capitalists, new rounds of VC, to the AAAs going into these secondary markets and being traded among investors who've never actually seen any of the financials of this company, of these companies, and then the companies that are now being traded in the secondary markets really quickly moving into IPOs.
Yeah, I agree with that. There might be a rush to the markets. Remember, the fact that LinkedIn raised its IPO price in the last couple days, what that means is that they had big interest during its roadshow from mutual funds and hedge funds and other prospective buyers. They didn't just raise it so that the insiders could get rich. They raised it because the banks are telling them, we've got interest. We can sell this stuff at a really high price. What that says to me, if I'm another private company, is get in now while the going's good, and also means that this private company valuation that we've been getting happening on the secondary markets might actually be legitimate. That might be a legitimate baseline for us to work off of when we ourselves try to go public.